Hello, hello, everyone. Welcome to another episode of Financial Tides. Today, the topic we're going to be talking about is charitable giving. I'm joined with my co-host, John Perillo, Certified Financial Planner, and I'm Taylor Perillo, Certified Financial Planner as well. So just diving right into it, everyone loves a good win-win situation. So when talking about charitable giving, that's what we're talking about here. There's many ways you can give to charity and help yourself out while also helping out a good cause or something that's near and dear to your heart. So we're looking for the tax benefits in the financial planning aspect of it while doing good for others. So when you give into or when you give to charity, you can lock in different tax deductions and you can also save money for your heirs. So there's two different topics that we're really going to be focused on today. Tax deductions, meaning a write-off immediately on your taxes, and then saving money for your heirs more specifically is reduction of your estate size so that you do not have to pay estate taxes, which is a big number right now, but it's prevalent that we talk about it at the moment because in 2026, that number may or may not be going down depending on the tax code that gets implemented in the next election cycle.
Good. And I think it's probably a good time to mention that with the standard deductions being so high, a lot of people won't always qualify to write off their their charitable contributions, their small ones to their church or synagogue or American Red Cross or the zoo and or an organization like that. So one of the solutions is to consolidate your donations into higher income years or combine so that you say, all right, you know what, I was gonna give them $1,000 this year and $1,000 next year. Maybe in December, I'll give them the whole $2,000 and let them know that it's 1,000 for each year. But now I've got the $2,000 in the same year, and it's in a year where I can possibly benefit from having combined. So that's one of the tricks, and we're going to get to a couple more tricks later for people who aren't itemizing. Um, and so I think the essential thing here is to stay in touch with your tax person and us, your financial advisors, and let's forecast where you're going to land in that given year.
Yeah, and I think the other thing is a lot of people think of charitable giving as just a financial aspect as far as dollars go, but they forget about the appreciated goods and different items that they can donate as well. So, for example, if you have a classic car that's appreciated, you're no longer driving, and you say, "Hey, I'm not going to use this car anymore. I can either sell it or the money that I typically give to my church, I could give this car in lieu of it." And then you avoid capital gains on that, which saves you taxes and saves the tax liability, and you get a deduction for the fair market value of that asset. And that happens for both stocks, bonds, anything that has appreciation. You can donate that in lieu of dollars and avoid paying capital gains on that because the charity is tax free. And then another way you can maximize your tax deduction on a high income year, or possibly on the estate, is to just give in something like a donor advised fund. You can move funds over, which is a little more in the weeds, but if it's something that you think you may want to do or have any interest in, that's something you can get in kind of more detail with us.
Excellent. And by the way, if you want to get rid of that classic car, you can donate it to me, but it's not a charitable deduction. You're just donating it to me. So, all joking aside, this next area is one of my favorites because it applies to everybody on this call. So, not everybody's got, $15 million to avoid needs to avoid a state tax, but everybody 70 and above can benefit from what's called a qualified charitable distribution, QCD. And so it's interesting because it was started for 70-year-olds back when 70 and a half was the RMD age, required minimum distribution, which is now older than 72. It's actually everybody 73 now, and that's going up over the next few years. But they never changed the QCD. So the QCD allows you to take money from your IRA tax-free and go directly to charity. So I'm just going to give you a simple example. I'm a person that gives $100 a month to the zoo, and it's a qualified charity. and I'm 75 years old, and so I don't itemize anymore. At 75 years old, I have to take out $1,500 to pay the tax of 300 in order to net the 1,200 I want to give to the zoo. And so now I've created a $1,500 taxable event. If I just tell my IRA company I want the $1,200 to go directly to the zoo, and they have an address for that and a Dropbox or some way to do it, they all do. It goes $1,200 from the IRA right to the charity. I don't pay any tax on that money. And if I'm RMD age, it counts as part of the RMD. So I know there's a lot to chew on there, but again, it's called a QCD. You can go up to $100,000 a year. And they even work if you do itemize because you still get the money out of your IRA tax free. So I think they're wonderful, especially if you don't itemize because you're giving away money if you're taking a standard deduction, pulling from an IRA and then sending it to your charities, the Helen Woodward Foundation, et cetera. And they're all qualified charities and they're all built to accept QCDs. So they have resources there. They can email you immediately and say, this is the PO box, this is the tax ID number, and then we'll send you a qualified receipt.
Yeah, and I think other than the IRA money that you can donate in the qualified charitable distribution way, there comes the next item, which is charitable trusts. And I think that these are, even though you're not getting the impact on your immediate tax return and seeing it right now, you can also get the benefit, which is the second part of that, which not leaving as much estate taxes to the heirs. So by doing this, most charitable trusts are designed to meet the needs of the owner during their lifetime, but then leave the funds that are left over that you don't need during your lifetime to the actual charity as the leave bequest. So basically you get taken care of in your lifetime, and then afterwards it goes to the charity of your choice. So I think that's a really kind of generous way of people saying, hey, I don't really have heirs, or I have enough assets that my heirs don't need all of it. I want to be generous to a charity as well. But I don't want to part way with my money kind of in between that process.
Great. And so, we'll address the two types that Taylor mentioned, the charitable remainder and the charitable lead. I'll do charitable remainder first, and I'll give you an example. So charitable remainder trust is what it sounds like. I donate the money to the trust. That charity can count on it because it's irrevocable and it's money in the bank for them down the road. In the meantime, that money generates dividends and interest that can come to the donor or the donor's family, and we can collect income from that. Let's say it's $1 million, right? We can collect 40 or $50,000 a year every year, and that organization knows they're going to get the $1 million, or if it appreciated at all, even more. I'll give you an example. I mentioned the zoo a couple times. I live in Escondido, California, right near the San Diego Zoo Wild Animal Park, or now it's called the Safari Park. And when I walk around the park, I see benches with people's names on them. When you go to the tiger exhibit, the preserve, it's called the Tull family, Tull, family preserve. These things were not built by just luck. They were built by people sending funds to the zoo and saying, we want to have some lasting impression. So, and one more example is if you go to some of the displays, the gorillas all get named by donors. So baby Joanne is not a baby anymore, and Monroe, who's a teenager now, gorillas that I've watched from, when they were little babies in their mom's hand, they were named because of donors with either charitable remainder or charitable lead trusts. And Taylor, why don't you go over the lead trust?
Yeah, so the lead trust is also irrevocable, meaning that you can't change it. So it's designed to really get an income stream out to a charity. So during your lifetime, this is something you would do. So you'd set it up and basically say you have $1 million, whatever the income stream, the value of that total income stream. So you can set it for a certain number of years. You can write all of that off in one singular tax year as a charitable donation, even though the income stream is happening over time. You get to write off the entire present value, which does help you on your current tax return, may give you more. Remember earlier we talked about lumping everything into one tax year. This is a way to split out your charitable donations over a couple tax years, but have a planned donation stream. And then all the remaining assets, once that income stream runs out. So if you set it for a 10-year or a 20-year timeline, the remaining assets that stay in the trust would then go to the heirs. So if you have, say, two kids and you wanted to get a nice tax deduction all in one year and you know you're going to donate money to the zoo, we'll keep with that theme. Every single year you're going to give them $1,000 a month. You could have that income stream set up in the form of a trust, but take it all in one high income tax year if you have like a golden handshake scenario. And you want to do all your write-offs basically up front instead of over time, and then take the standard deduction going forward. So that's kind of the way a charitable lead trust is used, and when we see it most often kind of in play is trying to use it to offset a large income year. And that is all we have for today as far as charitable contributions go. So thank you guys so much for your time.
Thank
And
you.
until next time, we'll see you on Financial Tides.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.